I've got Andy McOrmand, a gentleman I'll introduce you to in just a moment. Many of you may know him already from CNBC, Bloomberg, Fox News, where he appears frequently to talk about large trades that people are executing. This is our disclaimer. As you're already familiar, if you've seen us in any of our live streams, we always try to let you know that these discussions are not meant to be investment advice. They are meant to be informational as well as educational. And you should view it that way. If you need to discuss your personal situation, your investment goals with an expert, we encourage you to do that with a registered person. With that said, I couldn't have a better guy, a more fun friend.
Thanks, John.
And somebody who really knows what's going on in the markets, folks, than Andy McOrmand. I'm going to give you just a little bit of background. Andy and I have been friends for 15 or more years. Andy has been one of the biggest institutional brokers on the street, folks. His firm that he's a managing director at, Wallach Beth, is, I believe, and we'll draw this out of him, but I think they're having a record month. In other words, some of the biggest traders on the street, the whales, the hedge fund folks, the endowments and pensions and so forth that are looking for 1 million, 2 million, 10 million shares of stock. Andy and his firm don't make that commitment of the taking the other side of that trade, but that's why they're trusted, because they go out and find the other side. In other words, somebody who's afraid that another broker might run ahead of them and trade that order and basically cause them to sell lower or buy higher. Instead, they go to a broker like Andy and say, hey, you know, I trust you. Go out and get me 2 million of this ETF. Go get me 10,000 of this option. And I don't expect to see it print in a whole bunch of prints ahead of me.
Yeah, exactly.
Anyway, Andy, welcome, my friend. It's great to have you.
Thanks, John. Yeah, the background is important to note. It's we are having a good month, and thank you. But of course, you know, we wish that this would go away for everybody's health, and most importantly, the employment as well, and get everything back on track. What we do is just a real quick lessons and promotion of what everybody should do. It's, you know, why are we doing well this month? Not just because of vol, that's the catalyst, but it's just if you are set in your ways during low volatile periods, you cannot be set in your ways in high volatile periods. And we just have, you know, there is a ton we'll talk about of liquidity strains. The market needs the people to stand up and provide liquidity, but they are going in and out on a daily basis, depending on what their risk books look like. So obviously it's our job to find the different pockets of risk in the different asset classes. And, you know, I wish we were this busy all the time, but we understand how it works. And that's what we're here for, anyone from retail all the way to high-end institutional, which we'll get into.
All right. Well, first question to you, Andy, is given the volatility in the market and so forth, how are some of your biggest clients doing right here? Of course, I'm not asking you for names.
Right. Well, we'll start with the biggest. I mean, our entire, you know, bandwidth of customers goes from retail, then to RIAs, then to strategists, then to fund managers, then what I would call larger institutions like insurance companies, all the way to endowments, and then up the chain to state pensions. They all behave a little differently. They're all involved. I mean, that's one thing I would say. You know, they're all involved, all for different reasons, as you can imagine. So you asked about the larger ones. We'll start with them. So from the top down, with larger ones, you know, there is liabilities with insurance companies that need to be met. So there are securities put to work for that. There's income that has to be done. So there's insurance companies that usually trade the dividends. They've been a little more quiet because is it worth, you know, getting in, you know, the volatility in and out in a 2-day position to capture a dividend when the market could be down 5 or 10%? That's kind of dampened that. You still have obviously industries that have pensions, educational pensions, state foundations that have workers that are putting money to work. They have to fund those pensions. They're buying. I mean, that's one of the few pockets we've seen of actual customer buying, right? Are the higher end people that have to put money to work. But I would stress There's not a lot of thought into buying dips, right? What is done though, and a good tip for anybody is when you have such a ratio, John, I'm sure your site and your data can put that out. There's obviously a skew to the sell side. You know, there's buyers, but there's clearly a skew to the sell side. And when that happens, it's smart right away to think about your trades. Like if you want to buy a dip, but the market is nothing but just down, down, down. Should you average into that dip? Absolutely, right? You want to buy, you see the market's crashing at 10. Don't buy your whole position at 10.05. You know what I mean? Like buy a little at 10.05 and a little at 11.05 and a little at 12.05. And at least in the past week, that trend has, okay, you're buying your dip, but you're not trying to pick this market. And the down days have trended down throughout the whole day. And then sort of the couple of up days, I think it's one of every 3, has tended to trend up. So the institutions are buying, but they are staying away because they're taking our advice, which I'm giving everybody. You don't have to be an institution to have that advice, to not just go out and jam a block buy on when the bias is to sell side. So we have institutions that are buying. We're trying to work those orders into the system a little bit to capture the downside skew. I think options is an interesting question as to which we can, I think maybe we'll go with this with every different kind of customer, but I'm not seeing a lot of option flow from the large buy side institutions. Of course, hedge funds are doing it, but since we're covering that for now, volatility is extremely highly priced. Maybe you want to comment on that, but the skew is negative and the skew is high. Institutions are not, unlike hedge funds, are not going to put on naked option positions. They're going to buy protection. However, the cost of buy protection is extremely high right now. So we have seen that kind of, mitigate. In fact, we've been asked for advice on how to do that. And because, again, we're agency and we know we could get a trade by saying, yeah, just buy some puts. We have to map out what that looks like and how much those puts will decay and it really decay, John, if the market takes off. Maybe you want to comment on that a little bit and we'll get to that.
It's one of those things, folks. You've heard us say it many times that basically the square root of 256, which is more or less the number of trading days in a year, because of course we're going into a weekend where you won't see these futures trading again, folks, until Sunday night, basically at 6:00 p.m. Once these futures stop trading in the after hours here, they're shut. And so if you take the number of real trading days in a year, it's more or less 256. That means that for every 16 reading of a VIX, you're looking at 1% move projected. And that would fall under, we're talking about flattening the curve with coronavirus. Well, they use the curve for all kinds of things.
Right.
As most of us know, Andy, from college and high school, they grade on a curve. Right. You're sitting there looking at that curve. Most of the scores, the A's aren't supposed to be in that fat part of the curve.
Right.
A's are out there on the tail. So are the F's. Right. You're not supposed to see, the best grades, bunched up right in the middle.
Right.
So that's the first standard deviation, folks. Then you've got the second standard deviation and a 3 standard dev move. What we've been seeing are these crazy standard deviations where we'll see, a 5 or a 6 or a 9% move in a day. And, if you multiplied 9 times 16, folks, that's what the VIX would be if indeed you were seeing, a 9% move and the market was predicting it. So for instance, 9 times 16 is 144. So that's just 16 times 9, 144 would be your VIX if indeed we were seeing 9% moves like we had Monday, for instance, this week when the market was melting down 9%, 10%, crazy numbers, Andy. But to Andy's point, folks, that can vaporize like that. Now, that doesn't mean we go back from high 70s and 80% vol down to 16.
Yeah.
We're going to make several ratchet moves when we start seeing a sustainable rally. We'll start seeing it ratchet down. And we might see a drop, very quickly once we get down into the 50s. Right. You could see a 20+ point drop. I don't mean percent, I mean 20 full points from 50 to 30 like that. Right. And that would take.
I think we'll stay on. we'll stay with that a little bit. I definitely want to be able to tell you guys what the different clients are doing. I think that's relevant to your thought process, but just staying on that VIX topic for a little bit. So everyone on the show can understand, watching the show, why it might collapse and not. And again, the word I've been talking on to customers and the media all week is uncertainty. There is no other word to better describe what's going on than uncertainty. And this is not an economically, this time the catalyst wasn't something in economics, right? It's a health issue, which is causing that is uncertain, which causes uncertainty in the market. And the reason why the vol is so high is everyone should know that the market makers, and there'll probably be stories about some of these guys getting blown out in the next couple of days because of the amount of risk that they have to take on. But they are professionals that are very, very good. Their entire job is to just map out the math of these probabilities. And the uncertainty, and I'm certainly not, I think the uncertainty to me is on the upside of this, us getting through this. But if you had said 2 months ago, what are the chances that this is it? It's all over. This is going to end life as we know it. It's 0.000.1, right? It's like the same thing as a meteor or a zombie apocalypse, right? In the commercial. Not going to happen. You can't say that today. Now, that doesn't mean it's a 5% chance or a 4% chance or a 3% chance, but whatever the number is, and that's not what we do for a living, no one can say with certainty that this is not going to get worse. So when people go to make trades and they want to start dumping things and the public's scared, and we'll talk about the different people that are still selling stuff in a minute, but when you have that situation and you're putting a firm to task as someone to transfer risk, right? It's called risk premium. I want out of this risk. I want you to take it. The person that's taking that risk has to at least factor in a 1% chance or 5, I don't know the number, just saying a chance that this could be 6 months, a year, 50% unemployment, 60% unemployment. Just that factor alone, they cannot stand in there and take in liquidity like they normally would. So their risk premium goes up, which then in turn causes vol to go up, which then in turn causes these dislocations in all these products. Remember, when it sticks to ETFs or anything you trade, right? So if you're trading, the people on this show that trade or watch their asset class, they understand that asset class. There's plenty of Jon's audience that just trades ETFs, and their understanding is what's going on with my ETF. The key to being a better trader is understand what's going on with the asset class that the ETF backs, not the actual ETF itself. Maybe you want to follow with that, Jon, then we'll get to the next customer group.
All right. Well, for instance, folks, I'm going to share a screen real quick, Andy, just because I think it sort of makes a point for us here. So on the screen here, folks, that's the VIX. So that's the cash VIX. That's not the futures. That's the cash. So basically, what they do is they take a whole bunch of strikes of calls and puts, folks, and they model that into a number that becomes the cash VIX. There are also VIX futures that are traded out, April, May, June futures contracts. And when you're looking at this one, look at the drop off, for instance, in the VIX when it was just a couple, this is from the 18th. It peaked up at like 86, 88, something like that. Highest levels we'd seen since the financial crisis, and not the highest since 1987, Andy, but
right.
Screaming high, crazy numbers.
Right, Jon, maybe you want to show them like a 3-month chart or a 6-month chart to just show them how this, even on the same day, to show them how this is just exploded.
Sure, let's do it. So, for instance, here is that 3-month.
There you go.
chart.
Yeah, there you go.
Talking about, folks. And by the way, an 88 VIX, using the math that Andy and I already did, would be a 5.5% move. Because
right.
16 goes into 88. How many times, folks? 5.5. Right. So in other words, you would be saying we should see 5.5% moves in the market on a regular basis.
Right.
Obviously, this week we have done that.
Right.
But look at what is, here's the beginning of February, when the VIX was just under 20, it's 18. And people probably thought, oh, it's elevated, it's trading 18.
Right.
And then here it is, into that expiration because that first expiration in February was, I believe, the 21st, Andy. So
Right.
when you take it out right to there, the VIX pops from the mid-teens back towards 20, and then take a look how quick we get to 40, folks. The very next week, we're at 40. And as you've seen on the chart here, there it is, basically 2 weeks later, we're in the mid 50s. There we are pushing into the 70s. And there we are. Let me shorten it up again to, there we go, 5-day. So one of the important things is today, the S&P 500, dropped dramatically. We were at lock limit in the NASDAQ, folks, and gave that up in the pre-market, not all of it, but a lot of it, and started moving to the downside. People started aggressively, trying to sell out long positions and so forth into that rally, like they should, because that's what I've been preaching, Andy, is that, on big rallies, you become a seller. On the big dips, I'm more of a buyer. And we can talk about, what I was buying and what you were looking at to the extent that you can. I'm not trying to put a gun to your head, Andy. But look at where we closed out. We closed out below 70 in the VIX. And people might say, how's that possible? We're down 900 today. Why would we be this? Well, what percentage move, folks, did we make today in the S&P 500? 4.3%. So we don't justify an 88 VIX.
Right.
We don't justify a 70 VIX. You know what I mean? I mean, you've got to look at it that way. And that's why when Andy says, whether we rip or whether it's just that people don't need the protection as badly, they don't think that we're going to see 9 and 12% moves out of the market. The VIX is still way too high at that point.
Right, and you're still full. Just because it's not done, that doesn't mean the market makers want to lower the VIX or make protection cheaper so you buy it. You know what I'm saying? They still have to protect themselves. They're the other side of the trade. Of course, if you find a natural, that would be great. But when you have a skew like this, there's just very, very less buyers. John, if you want to put that chart up for one more quick second. I don't want to get too hung up on this topic because I want to tell the viewers some things that are going on. But if you put that same chart up to the 5-year thing, or just the 1 year or 1 month, yes, 3 months, whatever, just to see the flat part of it. So if you look from that all the way to your left of the 20th and then through, even though that's a higher VIX, the point is buying and selling and puts of those days, man, that seems easy to the traders and the clients, right? Like, this is great. I sell puts, and if it goes cheaper, I buy stock, but pretty much just expires all the time. I mean, you could be looking at a chart that was years, it'd be the same thing. And then I'm selling calls against my position, and I get yield all the time. You know what I mean? Like, it's just not the case anymore. And even me in my personal account had back a few months ago was selling puts just like anybody else to try to buy stocks on a dip. Well, I didn't think I was going to buy them $20 lower, right? So I had to cover some of those positions. I'm selling puts $1 or $2 out of the money, for $1, and then the stock's down $10, right? So people have to be really careful about that. John, your audience is mostly sufficient enough to put on put spreads and things like that, but I just want to make sure that we mention that. Now, getting back to what clients are doing and what means more probably to day-to-day flow, because again, the institutions on the high end have to put money to work. If they start really dumping everything, I would say that's a much bigger warning, right? Because they are only going to sell everything if it's to raise cash. They are not getting customers that are like, sell. They don't have customers. They're the buy side, right? So you get down to the next level, and I would call that mutual fund managers and ETF managers. They have been very busy, okay? In ETF managers, of course, you just have the rebalance activity. There's tons of flow in ETFs. They're done by APs on the day-to-day basis, but they're still act like mutual funds. They have to rebalance funds. As a matter of fact, today, I think, John, not that we saw a ton of flow from the large index vanguards of the world, but there was a rebalance today, right? It did not rescue the market. And folks, how that works is if you're running a fund that any index, let's just call it the diamonds to keep it less stocks, right? Not the S&P 500. You have to reweight those stocks. So generally the ones that are way down, and I mean they're way down, right? Boeings of the world are down. You have to rebalance your portfolio and buy Boeing and sell Apple to get it back in line. Didn't rally the market today. What does that tell you? I assure you there was some buy orders out there on the close of people that had to rebalance and buy these stocks on the dip because that is what they are forced to do. It did not rally the market. So to me, that is, again, more of a negative skew sign to where things are going with that. Tactical. Let's go to tactical customers, right? We have tons of those. These are RIAs and or mutual funds, and I would even say hedge funds that can act as they wish. You give them their money and you say, hey, protect my money or make me more money or some kind of objective other than your 401k, right? Although some of the better ones can still manage 401k portfolios as well. Firms like Horizon and Stadion are very good at managing long-term money and institutional money and are rules-based firms. It's a big point to understand that a lot of the rules-based firms, and these are trillion-dollar firms. John, as I'm talking, maybe you can hunt for a chart that has like the 200-day moving average or even the 50-day or something like that, so I can illustrate a point. These firms, right, I would say in the last 10 years, they've done well, okay? I mean, they beat the S&P 500? Have they beat, the FTSE? Have they beat the MSCI for their international portfolios? Probably not, because we're in a 10-year bull market. Now, they didn't underperform. If the S&P's up 27, maybe they're up 20 or 19, because along the way, whether it was a Sharpe ratio or a moving average or momentum flows, these rules-based firms have to act on their rules. They are very disciplined. So they say, hey, something happened in the market, an economic thing, maybe the trade deal, right? An example is when we had the trade deal going on with China and the tariffs, the market was kind of whipsawing in this little range. But as the market went below the whipsaw, it would force these firms to take risk off because their job is to protect their clients' money. Firm like CMG is another one. They protect their clients' money. So there'd be these little whipsaws that would cost you as an investor 50 basis points, 100 basis points, and it would happen 2 or 3 times. And that is why at the end of the year, every year in this 10-year cycle, maybe they were down, and I'm not speaking about the specific firms, but firms like those were down 2 or 3% from the S&P. Well, guess what, folks? Now rules-based is going to work. And rules-based is going to work for probably an extended period of time, right? Okay, that's perfect, John, okay? So you see all those little dips, John? You can go to May. You can go to July, August, another one in October, right? As those cross, those firms are selling. And then they don't really buy back usually until maybe it's a little bit above it. So you see these little whipsaws, right? And it's a lot of market activity. And these long-only firms aren't doing a lot of activity. So if you had asked me during all these time periods, who's trading, I'd say, well, we're seeing some tactical guys, they're selling below the moving average. We don't know if the tariffs are going to last. And generally all these economic things have their way of working themselves out. Now let's go to right now where we see March. Now we have a pandemic, right? They did not know it was a pandemic. Nobody knew, or we all would have sold, right? I'm the first to tell you that if you're a long-term investor, you should be keeping your money in the market right now. If you didn't sell already, don't sell now, right? In general, because you're going to take this big drawdown and you don't need the money for 20 years. So in general cases, but of course, if I could have told everyone to sell on February 24th and buy back now, of course that makes more money. But nobody has a crystal ball. Not a lot of people do that. But these rules-based guys, when those averages got crossed, it didn't matter the catalyst. They sold. They stuck to their rules and they sold. And I've just mentioned those 3 firms. Those are 3 leaders in the space, the Stadion, even on the insurance business, the Milliman, right? They take those rules and they sell, and they are way ahead of the game. Way ahead of the game. They have been in cash for weeks. And here's the thing. If the market were to snap back, like in December 2019, which is not an immediate snapback, but looking at it, what do you have? A couple weeks there, right, John? A month, right? Yeah. And I don't mean to the top. I just mean that kind of V, and then we're on our way back. So overall, maybe it was 2 months, but you have these other more violent ones that are a shorter time period. The 50-day doesn't really move that much, right? So like if we were to have a V recovery right now, which every day this goes on, there's less and less of a chance of a recovery. And I'm not a scientist or a healthcare professional, so it's looking like it's not going to be a V-shaped recovery, right? Which means the longer this period goes on, and the L, John Perfect, or the U, mm-hmm. the 50-day moving average and the 200 will start to go down with it. And as that starts to get to a lower level, when these rules-based firms start to buy back in, they won't catch the bottom. No, I mean, almost nobody will, but they will certainly be near the bottom, and they will capture all this alpha. So it's just important to note they're not in the market. And those customers that we love to see them trade, they've been out of the market for the last 2, 3, 4 weeks. You know, of course, every fund has some different cash positions and has different investors that have short-term time horizons or different models that might buy the dips. But the tactical rules-based manager is really going to be a hero when all this is over. Obviously, which, again, disclosure, we're just talking about finance. Health and everything else is more important. But just speaking about finance and who's going to be the cream of the crop, the tactical rules-based manager, RIA, or mutual fund is going to do really well in the next couple of years based on the fact that their rules went off.
Let me ask you this.
Go ahead, John.
Are you seeing any, obviously with elevated volatility, so as you guys know, we call that vol.
Right.
When you see premium expand dramatically, because if you're pricing an option, folks, there's several things that go into it, and we don't need to belabor this, but basically how much time to expiration, what strike price, and of course, volatility. These are 3 of the big components for that particular asset. Now, when the volatility goes from 20, like we said at the top of the broadcast, to 80, that means the movement expected in that stock or that ETF becomes greater and greater and greater. And so the people that are selling calls and puts need to price that in, and thus the premium levels are going up.
Right.
Calls and puts are more expensive, obviously, at 80 than they are at 20. Now, that might just sound like, oh yeah, that's easy to figure, Doc. But as it happens, there are some firms that Andy deals with that probably become more and more interested in selling things like puts, out of the money puts in particular, because, you know, when somebody comes on TV, Andy, one of the most frustrating things for me is that they say, well, I really like Microsoft here, but I really like to buy it $10 lower. And you and I know there's a way to do that.
Sell a put, no problem. Yeah, you got it. Yeah. You get paid while you wait with a limit order. Yeah, that's the thing. People go, I'm just going to put a limit down $5. I'm like, oh, well, I'm going to get paid for that. Yeah, exactly. Yeah.
So when somebody has that outlook, folks, where they say whatever the stock is, whether it's the S&P 500 ETF or whether it's a stock like United Airlines that you think might get bailed out or whatever, there are people, I'm not saying, again, giving you financial advice, I'm letting you know there are people who are out there saying, yeah, United, are you kidding me? I can sell the 12 puts for how much with the stock at 18?
Yeah.
I get basically, you know, I'm protected for a 30% plus drop before it gets into my money or anything else. And oh, by the way, if I miss it, I keep all of that premium.
Yeah.
If I don't get to buy it down there at 12, oh, well, somebody paid me to be Warren Buffett.
Yeah, I would say, John, I'll back that up and say and this will be the clear point for everybody to understand. I am a big fan of that. So the first thing I said was people be very careful about selling options. So I'll make it very simple. If you want to sell puts, naked is the word we use, right? And not a put spread. You just want to sell a put naked, which means, okay, whatever Disney, you want to sell Disney. Let's say you want to sell Disney 55s. If Disney goes crazy and trades even low, I want to buy it at 55. Just understand that a contract is 100 shares and don't sell for more than you want to buy. People just get into trouble because they'll do it 2 or 3 times. I sold 2 puts in Disney and I made for $2. And I made $200. That was pretty cool. Or I made $400. I'm going to do it 10 times and make $2,000. But you have to be able to absorb. And believe me, your broker is going to make you absorb it as it gets close to that. That especially now, margin calls, John, we know from our clients are earlier and higher and going up and faster because as it gets near, the vol is factored in. And if you can't buy 1,000 shares of Disney, remember, you sell 10 puts, you have to buy 1,000 shares if it gets down to that level. So, again, I'm all about the vol. I personally was sold 1 lot, 2 lots, because I'm willing to dip my toe in the water. But like John and I know, it's going to be lower, and it's just going to be what I'm willing to buy. That's it. You know what I mean? And then as far as selling calls, in this market, just understand that the skew is still to the downside. It's not even. You take a stock that's $100 and you look at puts right now that are 80, and you'll sell those, and then if it rallies to 120, I'll sell this for the same price. Not going to happen. When that chart we showed a couple months ago, sure, it's probably even. You will not get the same premium for a call 10% out of the money as you will a put. Correct, John?
Correct.
Yeah.
The fear that builds into puts, folks, especially, I mean, you've heard it time and time again over the last 3 weeks. We have not seen a sell-off this fast. We've seen a 22% sell-off in one day. That was October of 87, October 19th, 1987. Other than that one day, we have not seen that kind of carnage. But this carnage that we're seeing right now has people just scrambling for any kind of.
And I would say too, John, to make people feel comfortable, we can't forecast everything. The probability of an 87 type crash or an 08 or, is different than this or a 9/11, right? Because they're driven by economic things. And we have come a long way. This is what we're doing right now. It comes a long way to educate the public. But the market, they've done a great job at market structure to stop economic catalysts from causing days like 1987. The issue here, it has nothing to do with economics. The fallout is going to be economics, right? I've been saying all along, I'm way more worried about the economic fallout. I think we can get a control on this virus if people follow their quarantines and stay healthy. I do believe we'll come out of this. So my next concern then goes to the economic fallout. And I don't know what it is, because the catalyst is not an economic catalyst. It's a healthcare catalyst. And that is what causes people, again, I would want to explain why the markets are so wild, why you have dislocations and things along those lines.
Yep. So Andy, maybe, you've got folks like yourself out bringing in business. You've got traders on your desk that are constantly matching up, as we said, top of the show. Wallach Beth doesn't commit capital, folks.
Correct.
That's why they're a trusted intermediary, because somebody calls them, or somebody that has told them, hey, at this level, give me a shout. That conversation happens, and they give Andy, for instance, instructions to go out and buy me X amount of this ETF, because maybe it doesn't usually trade 2 million shares a day.
Yeah, they have to sell it, right?
Yep. Right. So they got to find the other side, and they're counting on him not to race ahead of that order and cause them to sell it at an even worse price.
Right.
But how many of those kinds of orders are you guys getting right now?
Yeah, so that's the next chain. So now let's get away from the tactical. Great question. Now the next set of customers that we deal with, right?
Yep.
Non-rules based guys that are like, I gotta beat the market. You know what I mean? And they've raised money, and they're hedge funds, and they got to come up with ideas. And man, we're getting those orders. It just reaches people's pain points. And I would again say the skew of those orders is certainly on the sell side. We are getting buy orders, but we are getting people that are like, okay, it's time to sell. It's, I've got a certain amount of things that I have to do for certain motivation. Interestingly enough, we're not seeing a ton of short sellers. That's not our particular thing. But I think, again, the risk of being a headline market and no one can predict it, I think we're not seeing a lot of short sellers, because if, just like I said, there's a chance, John, that there's whatever that number is, very small chance that this is way worse than we all think, right? There's probably even a better chance that it's not as worse as we think, right? And that we'll come out of this. And people could short the market, but if, Biogen or some company or Gilead says, we got the cure, we got the vaccine, guess what? 2 weeks from now, it's coming out. Again, all this, probably unlikely. but because the chance of it is there, can you imagine how fast the shorts are going to get, their face, whoop, as we like to go to John, right? On the other side, right?
Yep.
So I want to tell people we just don't see a lot of short selling. We see people buying protection, putting on downside trades. The direction, triple levered funds, double levered funds are great ideas for putting on a short trade. But you have to understand that, watch it day by day. Just like any other, levered product, they reset every day. But it's just an idea how you can do that, and that's priced a little more accurately than the vol of options is another way to enact an ETF. They're just called short ETFs, and you can do 1-time levered, 2-time levered, 3-time levered. We've seen some action in those. Those are, I would say that comes down more towards the retail side of our business, which we don't deal with retail customers directly, but of course we have the pipes of the retail brokers that channel orders to us. And we've seen more levered ETF activity in that way, but not a lot of giant hedge fund shorting. We don't represent a ton in that space, but we just don't see it. And I think the common sense thing would tell you that with vol high, it can go the other way just as fast, right? You know what, John, I'll use that to give an example.
Okay.
When I was preparing, so people understand what it would look like on the upside, right? Because everyone is saying, why is the ETF, lower than the asset class? Well, they can't necessarily price the asset class at a bond. But not to get complicated with that, I'll just say, let's look at, all this is beyond us now. We get past this. We get back to the levels we're at. It's next September. Everything's calmed down. And on Friday afternoon at 2:00, right, the World Health Organization comes out and says, we have great news. One of the big biotech companies has found the cure for cancer. It's coming out Monday. Everyone's going to be okay. You know what I mean? We can't give you any more details than that. You know what I mean? What do you think is going to happen to the biotech ETF, right? Or I mean, it will explode to the upside, explode. And every customer will call us and say, I've got to buy stock now. And what market maker over the weekend is going to be able to appropriately price the cure for cancer? Like, okay, where do I sell this product? Because then I got to short it. Where do I do that and make sure it's not going up 4% the next day? That's an example we would all love, but you would see the rare explosion to vol on the upside. It's just telling people that it goes both ways. It's just an example that it can go both ways. This just happens, unfortunately, to be a downside example. But then you would see things exploding the other way. So for those kind of customers, we again have seen more sellers. They're doing blocks. They are paying more. We're not a magic bullet, right? It's rare that we're getting on the bid, right? We're getting stuff down. I would say our average block execution is like a 1 or 2 bips of impact, which is great. That's how we built our business over. And I'm talking about $50 million trades, $100 million trades, $1 billion trades in 10 ETFs. We'll do the whole thing in 30 minutes and be like, or 2 minutes or 5 minutes, like, you had 2 bips of impact, you had 1 bip of impact. And of course the customer's like, that's fantastic. That's why I use this. We moved $1 billion. Just being truthful. Someone wants to call and give us $1 billion right now. We can pre-trade it. We can have an idea, but it's going to be 10 bips, 20 bips, 15 bips. Or cents wise in a stock, it's 10 cents, 20 cents, 15 cents down, 5 cents down. That is still way better than working an order in something that doesn't trade a lot and disrupting supply and demand, right? Maybe, John, that's a good time to talk about supply and demand. If you disrupt supply and demand, folks, or your order disrupts supply and demand, or you are trading in a product where the volume, while you're looking at it, is more than the average volume, be prepared for more volatility in that product, right? If someone is really selling it and disrupting supply and demand to what the underlying asset class can handle, that's going to put a strain on that and put that risk premium price on it. And again, to use that word risk premium so everybody understands, that is the price paid to transfer risk, right? That's what we're talking about here with a block order. When your broker or your financial advisor decides he's going to sell all his clients' product at one time, this is all right, okay, it's time to get out. Those are the orders we're talking about in the last 2 weeks, 1 million of this and 2 million of that. Those are orders where a bulk of money has been decided to get out. He is transferring the risk. He is long all those names. He's now asking a market maker to become all those loan names in 1 second. I have 1 million shares for sale. You buy it. The price to take on that risk has gone higher, just like vol. So risk premium. And that is why we're seeing lower blocks. But learning point is, again, I'm not saying everybody can access Wallach Beth, I'm not promoting it, but the things that we do can certainly be applied to everyone as a general practice, right? And that means look out for those volumes. Man, I've been trading the copper ETF for 2 years, and I love it. And it does what I wanted to do. Well, today the volume in the copper ETF is 4 million shares, and maybe it's usually 40,000 shares, That means somebody's leaning on it. It doesn't mean everyone's buying and selling copper. It means one big order is either selling it or one big order is either buying it. So pay attention to that. Call the issuer. All these ETFs companies have capital markets desks. They will at least try, especially if the asset class is open, you can use INAP to give you an accurate reflection of what the asset class is worth. You can make a smarter decision about what the ETF is worth, right? Like I said before, if the skew of a market is really coming in or out, and I don't mean something that's hard for our listeners to listen to, John. I don't mean like figuring out implied vol. I just mean you're looking at a chart and it's going like this, be careful, right? Like go with the chart a little bit, right? Don't fight the tape. I mean, it's really hard. You can apply that practice to an order you're working during the day. You can apply it to an order you're working for 5 minutes, right? You want to buy on a dip, but the market's dropping like a stone. Well, then, put in a 10-cent bid, a 6-cent bid, a 1-cent bid, and a 97-cent bid with a handle lower and see what happens. And then if it works, I have people come up, great, you just saved me 10 cents. It's something, right? But you watch it, and if it starts to bounce back up, okay, then you don't do it. All this kind of gets forgotten when the chart's like this, because people get really satisfied with liquidity, and I'm going to get in and out, and I'll buy my options cheap. I'll sell options, and I'll never get put to stock, or I'll sell calls and I'll never get called, right? Which is why I want to explain to people, they have a set call program, right, John? And these stocks are down here, and they're like, hey, I sell calls in Disney 5% above my position every month, or 5% above, where it's trading. And hopefully we get a cure to this virus. The market's going to blow up, sell your calls, and it's like you sold it down 40% anyway, right?
Correct.
So all lessons that need to be learned, right? If you're selling calls, understand that your basis is a lot lower, and you're not going to get a premium to sell calls up 40% from where you bought that stuff.
Let me show you one quick one, Andy. So this is, of course, when I talk about, whether this is something that we want to flatten this curve, folks, these are standard deviation moves based on a bell-shaped curve. So as you can see, 68% of the time, we should trade within those bands. You can see them to the upside and downside. Those would be C's if this was grading, Andy.
Right.
These would be B's out here in that 13.6 range, right, or D's, and then they would be A's and F's. Now, we all know that, for instance, the Ivy Leagues and a whole bunch of other schools, I'm not just degrading an Ivy League, but a whole bunch of schools have grade inflation. They've got a lot more A's and B's than they should have, but that's how they get, the rankings on U.S. News and World Report, right, and that, their MBAs are coming out and getting hired by Wall Street or Facebook or Google or wherever it is. Anyway, the reason I put this up here is when Pete and I are looking at this, Andy, way out there on those tails. And again, those are black swans, folks. Somebody getting, 5 on a 4-point scale.
Yeah.
In
the grade chart
of a grade or whatever. Those are black swans. Those are geniuses, or they're idiots if they're on the other end.
Right.
Curve. And what we're looking for, Andy, is as far as triggers, we may have seen one 2 days ago. We may have, when we hit that 85 or 88, whatever was the high for vol 2 days ago, we were out there on that ragged edge of this bell-shaped curve. So what we're using to try to direct ourselves into the best opportunities is keeping our powder dry until we see way out there on the edges of that bell-shaped curve. Now, Stadion, one of those big firms that Andy spoke of, or Horizon, or any of these really smart, big money managers, they have their rules. Pete and I have our rules. You guys have yours. Andy has his. One of mine is that I'm waiting for, the trade to be way out there on that curve. So, fair to say that I did pump some puts out. I think you did too, Andy.
Yeah.
And you don't have to tell us which stock or anything if you don't want to, but
it just seemed high. I mean, look, there's to me, and this is obviously nothing to do with Wallach Beth, but I don't mind talking about what I do personally. To me, with the leaders, some of the banks like the Goldmans and then Disney and maybe just stocks that you love, I can't, again, anything could happen, but for me to want to buy on a dip and to say, I used to, and that's what I do, right? I, for my personal account, sell naked puts to buy stock, right? Lower. And, I usually have to do it within a couple bucks, or let's just talk about percentage points. Sorry. A couple, maybe 100 basis points to just get like $1 of premium. So it's like, oh, kind of cool if I don't make it. You know what I mean? Like, but I'm talking about, I was selling stuff earlier this week that was like $30 or $40, 20% out of the money, and still getting $1 for an option that was 5 days from expiration. You know what I mean? Like, and I get a good point about that, John, is how quickly they can evaporate if you went back. You don't have to bring it up, but the chart where the VIX actually kind of went down, right? Like, if people are going, hey, the market, did we hit an all-time low today? I believe we did, right? Not an all-time low, I mean, of this whole crisis, right? We're at the low of this crisis. But yet the VIX isn't at the highest level. Why? Because things are like we're starting to absorb some news. Like the percentage that it's the end of the world goes a little bit lower every day we get through this, even though it was low anyway. So that will just dampen vol. And, but if you get those spikes, one really bad headline, John, which I don't even want to say because we don't want to imagine bad headlines, but one really bad headline could bring that VIX right back up. And then your ability as a trader to absorb what that headline means, what you think it means, because again, these are health and world headlines, not necessarily economic. I don't think someone saying Disney's going to go out of business blows up volatility. It certainly will raise it. But somebody saying we've got to shut down Florida for the next 2 years raises, because we're going to, like the California guy saying, the governor last night saying 25 million people are going to get it. I'm not saying he's right. I'm not saying he's wrong. Those are headlines that increase vol.
Yep.
In this
well, take a look at this one, and then I'll be quiet, and we'll probably thank Andy for his time, folks. But so, for instance, I said that I hate it when people come on, Andy, and say, I like the stock, but here's Microsoft,
right,
closed down $5 at 137. So I was getting back into some Microsoft here, and these are April options, folks, just so you see. This is live. April 17th expiration.
Less than a month away.
Yep, less than a month away. And here's the puts. So when Andy and I are talking about a situation like when somebody comes on and wants to sort of mealy mouth say, well, I like it, but I don't like it until it gets to 125. Look at the 125 puts right now, folks.
Yeah.
Give or take, they're trading at $5. They're 485 bid, offered at 650. We all know they widened it out going into the bell. And they're probably wide anyway. But taking a look at that, Andy, if I'm getting paid $5 for the 125s, that means, folks, effectively, I own the stock at 120. 120, it's trading 137.
Right.
I've got $17 of cushion. Now, could that vaporize? Of course it could. So again, like Andy said already, when we're trading for our own accounts, and when I'm selling puts, I'm not levering and saying, well, I normally would buy 2,000 shares, 5,000 shares here, or whatever it might be. That might be what I would buy. That would mean that I'm going to sell 20 puts because that would represent 2,000 shares. Or I'm going to sell 50 puts. That would be 5,000 shares. If I sold those, just to put it in perspective for you guys, if that put is trading for $5 and every put's for 100 shares of stock, every put that I'm collecting is $500. So if I sold 50 of those, I'm collecting 25 grand for taking the risk of owning that stock, Microsoft, if it falls to 120.
Right.
120 with it trading at 137. Now, I'm obligating myself to buy 5,000 shares of a stock times, let's see, 125. That's a $625,000 potential investment that I'd have. That's 5,000 shares times, or did I do that right? Let me see here, Andy. 125.
No, you did. Yeah.
Okay, 125 times
Yeah.
50. So what I'm looking at here, folks, is I'd collect 25,000 bucks in the next month for being long a stock that I want to buy down here below 125 anyway. And if it trades 125 or higher, doesn't close below 125, I keep all 25,000 bucks. A lot of institutions doing that. Andy's doing that. I'm doing that. Again, not for everybody, but if
John, even just saying, even to a smaller level, I mean, if you leave that chart up, you can get $1.22 for the 100s. I mean, what percentage drop is that, right? And again, if you're just like I just wanted to see some green in my trading account. I mean, like for a change. So like, I was like similar to that with Disney. I was selling stuff that was like $25, $30 out of the money for $1 just to get some green, like, and not more than I wanted to buy. Cause again, there's a chance that this whole thing is going down. So I was like, you know what? I don't know what to do. So me personally, meaning I wasn't selling 135s because I don't know. I don't know if we're not going lower, right? And if you can buy stock, if you take the healthcare out of it thing and you can buy stock lower, then why buy it now, right? So maybe the market's going to be lower. So if I'm going to sell 135s, maybe my decision is to wait to see if we go lower next week. Then I'll sell 120s. But I was simply saying, would I ever buy Microsoft if it hit 100? Yes. Will I probably be able to trade when that happens? Maybe not. So because I might be doing customer things and we don't trade when we're doing customer things. So I can't be involved in that. So I went ahead and just sold 100, the equivalent. I did it in Disney of what it would look like here, 100 put for this week. And it was still $1 and got $1 for it. That just shows you how high vol is. You know what I mean? And then I think we could prove a point, John, that I know we want to go of saying the skew on the calls is less. You know what I mean? But maybe that's,
All right, so let's do that, Andy.
Let's do something like, $10 to $15 down. So the 115s are 305. That's $20 down, right? Or 305, 390. Let's look at the calls, and I could be wrong, but let's look at the calls that are what would be 155. I don't know what last sale is. I can't see.
155s. Let's look. It's right up here.
Yeah.
Here's the 155s. They're trading for $2.80. It's a 56 vol, 56 implied vol. If you look over at the far side of that screen, that's the implied volatility column, folks. 56, and they're trading for $2.80 roughly.
The skew is downside, right? Well, the puts were what again? How much were the puts?
Those 115 puts were where was that again?
Yeah, 305, and probably 350, probably the midpoint. So they're a full third higher than the calls.
Yep.
Yeah, 33%.
That's, again, on that bell-shaped curve, folks, that's what that's telling us, is that it's out there on the tails of the bell-shaped curve. So that's my rules-based system. Hey, Andy, I can't thank you enough,
it was great talking to you, John. We'll be in touch, I'm sure, all next week, but stay healthy, and everybody else. You too, Andy. Folks, that's Andy McOrmand from Wallach Beth, Managing Director over there. Does a lot of great stuff on the institutional side. When I see unusual activity, I will frequently call their desk and say, hey, did you guys see this? And they might say, yeah, that's a really big fund getting involved or getting out or whatever it might be. Great information, great guys. And their reputation is everything. It's just like ours. So
when they're committing, when somebody gives them a $500 million trade, they don't want to see that thing traded ahead of their order. They want to see that Andy and his group have found them the best price they could get in the market. And that's how they built that business. So thank you, Andy,
Thanks,
for
John.
all that
Appreciate it.
great insight, my friend.